Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the simple Fibonacci strategy for beginners. If you have ever wondered how professional traders pinpoint precise entries and exit points, this video is exactly what you need. You will learn how to effectively use the Fibonacci retracement to identify potential market reversals and continuation points with clarity and confidence. At the end of this video, you will have a step-by-step strategy that can help you to immediately apply this to your trading strategy. Make sure to watch until the end of this video so that you wouldn't miss out on any important detail that could significantly improve your trading results. We start by understanding the simple Fibonacci strategy for beginners. The simple Fibonacci strategy is a powerful tool that combines structural analysis, Fibonacci retracement levels, and candlestick patterns to identify high probability trading setup. This strategy is rooted in the Fibonacci sequence, a mathematical concept that has found significant application in the financial market, and its core strategy focuses on key Fibonacci levels such as the 38.2 level. These are the key levels: the 38.2 level, the 50% level, the 61.8 level, and the 78.60 level. These are the key levels that act as potential support or resistance area, helping you to pinpoint optimal entries and exits for your trade. The beauty of this strategy lies in its simplicity and effectiveness, making it particularly suitable for those that are new to Forex trading. This level helps you to pinpoint entries and exit points. To implement this strategy, you first start by identifying the overall trend in the market. Once you have established a trend direction, you look for significant swing points. And as we can see on my chart, I have identified that we are in a bullish market because the market is trending from the downside to the upside. You can see market is making series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and a higher high. As we can see, because this particular high broke structure, it broke this previous structure. So as you can see, it broke the structure. It signifies that we are in a bullish market. After we have identified the Fibonacci retracement, we use our software to draw the Fibonacci retracement tool from swing low to swing high. In an uptrend, we draw it from the swing low to the swing high. As we can see, this is how we draw our Fibonacci tool. In an uptrend, this action would automatically plot the Fibonacci levels on your chart. As we can see, the next step is to wait for price to retrace to one of the key levels. When price retraces to the 61.8 level, this is referred to as a golden opportunity because it signifies a powerful reversal point. And as market has gotten to this level, you would want to look for additional confirmations such as your candlestick pattern or technical indicators to support your trading decisions. As we can see, when price got to this level, we looked for our bullish engulfing to let us know that market is ready to stop that retracement and go to the upside. Remember, the simple Fibonacci strategy for beginners is not just about blindly entering trades at levels. It's about using these levels as a framework to make informed trading decisions. By combining Fibonacci retracement with other forms of analysis, you can significantly increase the probability of successful trades and manage your risks more effectively in the market. Now let's apply a Let's apply this to our trading strategy for beginners. Let's see, to trade you trade with your simple Fibonacci strategy for beginners. You need to follow a structured approach by combining the Fibonacci retracement level with candlestick pattern. This strategy allows you to identify high probability entry zones, and based on the market movement, we start by identifying the overall trend, which we have already spotted out in this area. We can see that we are in a bullish market. We look for higher highs and higher lows. We can see this is a higher high, this is a higher low, this is another higher high, this is the previous higher low. Once we have confirmed the direction, because this direction pinpoints and they serve as foundation for plotting the Fibonacci retracement level. Once we have identified the swing points, the swing highs and the swing lows, remember they act as areas where we plot our Fibonacci retracement tools from. The next we need to do is to place our Fibonacci tool on the area. In an uptrend, we draw it from the downside to the upside. It will automatically plot these levels. While in a downtrend, let's look for a downtrend example. In a downtrend, we will look for price. We will draw it from the low, from the high to the low. This is where we draw our Fibonacci level in a downtrend. You have to do the opposite of what you did in the uptrend. This would automatically generate the key levels we are looking for. We automatically generate the 38.20, the 50 and the 61.8 level up to the 78.60 level on your chart. And remember, these levels represent potential areas for reversal reversals or where to continue the trend from. We first of all wait for price to pull back to this level. As we can see, when price broke structure at this area, this is the structural point where price broke structure in a downtrend. When price broke structure, we wait for price to retrace to one of this level, and as we can see, price has gotten to the 61. Let me make this clear for us to see. Price have gotten to the 61 area, has gotten to the 61.8 area on the Fibonacci level. Once confirmed, you enter your trade in that area. We'll enter a sell trade in this particular area, and we place our stop loss around the previous swing points. And as we can see, this is a previous swing point above the 100%. This is where we place our stop loss, just above the place. Then our profit target, you can either use the previous swing point for your profit target, or you can use Fibonacci extension areas. We can use Fibonacci extension areas for our take profit. Fibonacci extension areas for our take profit, which is, we can use areas like the 1.61 area for our take profit in a downtrend. And as we can see, this is the area we will take our profits from. This is where the Fibonacci extension extends to. While in a buying opportunity, once you have spot your areas from the reversal, we take a buy trade from the sweet spot 61.8 region. Then where do we set our profits? We set our profits at a previous swing high, or we will go using our Fibonacci extension tool. When we use our Fibonacci extension tool, we draw this and it will mark out areas that market might extend to. This is 1.61 level. This is where we can set our take profits to. This step-by-step approach ensures that you have not traded blindly, but instead used a systematic methods to capitalize on the market movements. By combining the Fibonacci retracement with additional tools, you improve your chances of making successful trades while managing your risks effectively. Alright traders, we have come to the end of this video.